Hello. In this video, I'm going to talk about the fallacy of technical analysis. Technical analysis has a deep, dark side to it that many people don't talk about, but it is a realization that needs to be talked about. I don't believe it makes it good or bad, better or worse, as I see technical analysis as nothing more than a tool with its own limitations. However, though, there are many famed trading experts who see this very fallacy as the whole reason to why you should never use it to begin with. I think that is overboard and extreme, but nonetheless, if you don't understand these limitations, it can have some very severe consequences in your trading. Now, I have a very simple chart on the screen that does modestly well with a $1,000 budget. It will make a $41 profit using 1% of the account balance per trade. Basically $10 every time it makes a purchase. But this uses accumulation, so as the account continues to increase in value, the amount you get in your position sizes will also increase over time. So let's take a look at this chart in more detail. Particularly, let's go to the beginning of the chart, where all of the magic takes place. I say magic, but it's really not. It's mathematics. And the mathematics has consequences. And that really is the crux of this fallacy. Ideally, we would have data to the beginning of time of any asset we want to trade. But realistically, storage costs of such data, along with the sheer amount of data, simply make it not possible to be able to keep that much information. So I have Timekeeper loaded at the beginning of this to demonstrate this whole process. So this part doesn't get traded. I explicitly wanted to start trading on a very specific date and time, because that is how I'm going to demonstrate this fallacy. So anybody who starts on this given date and time is going to get all of these trades exactly as you see. But what happens if somebody starts trading on the 24th? How does that affect the chart? Well, thanks to the Timekeeper module, we can actually see exactly how that affects the chart. Okay, now watch these two markers here. Notice they changed. They changed because the mathematics changed. This is the very fallacy of technical analysis. Your backtesting is only as good as the starting point that you have. Every time your starting point changes, your backtesting is going to change with it. Your historical analysis is going to change with it. Even without something like the Timekeeper, your historical analysis is going to change simply because the platform you're using has a limited amount of data. So no matter what, you're always going to run into this fallacy. And it is always going to have an impact. So if I start trading on the 23rd and somebody else starts trading on the 24th, they're going to get two different results. These results are for the same exact chart, same exact time frame, and the same exact asset. That is the problem of technical analysis. The point of being a scientific analysis is that the results need to be reproducible. But that isn't always the case. Now you see some markers remain the same. They don't change no matter what. Well, that's what's called cycle synchronicity, meaning they will match up on a wide range of possibilities. It's like the example of being 5 ways to 10. If you think about the number 10, you can have 1 plus 9, 2 plus 8, 3 plus 7, 4 plus 6, 5 plus 5. You can have 5 times 2. Multiple ways to get the same number. Now let's see how this looks on the end with the results. Let's put the results here. Also, we'll see if it changes the markers. So, same thing. We're going to put this back to the 23rd. And you see we have 72 trade cycles, 84 maximum positions. Now let's step it up and watch. Somebody starting on the 24th is actually going to make more trade cycles than somebody starting on the 23rd. Let's keep going, one day at a time, and see how this impacts. Now this is a very simple recipe, so you're not seeing any changes on the markers, which is ideally what we want. We want that synchronicity to help make the results reproducible. But you see there is definite changes taking place. And that is the whole point of this fallacy. These changes have restrictions. And those restrictions affect the mathematics. The nice thing is, though, when you have a moving average, the length of that moving average will eventually synchronize to a new state. So if you have, for example, a moving average with a length of 200, that means every 200 numbers, it should find itself in that synchronicity again. So let's keep going, see if we see any changes in the markers, or if we've managed to find synchronicity at the end of the chart. we definitely can see changes. Averages are changing, and the number of trade cycles are changing. Okay, let's jump up. Okay, let's go to the new year. Go to January 1st. Okay, so starting with the beginning of the year. Now that's interesting. We went from 60 something down to 54. Let's go back. So 67 on December 31st to 55. It reevaluated. All right, so good. It caught up finally. But notice how this changed. 23. Let's see when this changes. Okay, it's going back up to 25. So, on the 27th of December, the longest maximum count was 84. But if you started trading on the 28th of December for this very same recipe, your maximum number of positions is 25. A drastic difference. Literally 3 times the amount of accumulation. But the profit hasn't really changed. Your average is only a little bit different, 0.02%. So, does this undermine technical analysis? No, it doesn't. Does this highlight the limitations of technical analysis? Yes, it does. Every tool has its limits. Let's come back here. That is the important part. Every single tool has its limits. Okay. Now let's come back to Timekeeper and let's go for January 1st. So if you started trading January 1st, this is what your chart would look like. Now let's see what it would change in terms of somebody trading January 2nd. Okay, notice this matches synchronicity. It changed here and it changed here. So as you can see, these changes, let's see how it affects this. This should be interesting. Nice, good, steep movement. Okay, this one didn't change at all. So it doesn't seem to affect the upswings, but it does affect the downswings quite a bit. But again, you're looking at time in a different format, trading based upon time. So as you keep moving forward, your profits, trade cycles, they're always going to dynamically change. But as soon as it hits that upswing, everything synchronizes quite nicely for this recipe. Now let's go back to the end. Let's look at the profits. Notice here the profits went up quite a bit. So less trading is more profitable right now with less exposure. Now the whole point of this is very simple. Every time you come to this chart, you're going to get different mathematics. Every single time. If you come back to this chart tomorrow, then the historical starting point that you had is gone. And you're going to have a starting point 24 hours later. Some of your trades will be in synchronicity versus price action. More complicated algorithms most likely will not be in synchronicity of price action. That doesn't undermine the analysis, but that does show limitations of the analysis of two different people trading the very exact same asset, the exact same time frame, and still getting completely different results. So here, 23 maximum positions, or $230 if you're using $10 intervals. But if you started December 25th, you would have $840 wrapped up in this coin. Let's see how it looks here in the profit graph. Okay, let's see if we can get this over to where we can okay, let's put it on this side. There we go. Let's go back to December 31st. Since that's where the interesting numbers take place. Now, providing I don't blow everything up. Which I did. Oh well. Blew it up big time. Okay, so December 31st. Okay, so here we have the drawdown. Now at this point we don't have much of a drawdown. But on the 27th, if you started trading there, you would have this monstrous drawdown. But notice the difference in the numbers. That's the important part. even though this trade was successful, it had a huge impact on the total amount that the recipe actually traded. Okay, let's go back to the 23rd of November and show the beginning of this whole trend. So this drawdown had a huge impact, but it was a profitable impact if you could weather it. But if you started trading January 1st, December 25th, or 27th, you would have never seen this monstrous drawdown. Always test multiple levels. Always check. Because even though this recipe looks great here, it's all about when you start trading and how much data you give it. Because tomorrow when you come back, it might not be as good. Let's see if I can find a coin that proves that. Here's one. A week ago, this coin was profitable. Now, it says it isn't. All because of this huge rundown. This is where one does have to question the validity of technical analysis when you can't reproduce results consistently. That is, if you don't take into account that the market is always changing and that data has fixed limits for storage and retrieval. I swear by technical analysis, I think it is a critical component of trading, but it has its limits. Understanding those limits will only make you a better trader, because then you will understand how a perfectly beautiful recipe could turn into a hot mess. And let's see if we can demonstrate that. See, today is the 4th. So let's set this to today's date. And let's walk backwards and see how this changes. Okay, so let's go to 31. So here's January 31st. We went from 200 and, wait a minute, guess not, the 31st. Okay, so we actually went from 247 to 250. And it's only getting worse. We're getting to the bottom where it's wiping everything out. But notice the averages are still above 0. Okay, let's go to the 15th. Let's get to the fun part. All right. So, all right, so this started pretty bad at the beginning of the year. So let's find out when this turned to mud. Okay. Not what we want. There we go. Okay, the 22nd's not bad. 23rd's not bad. 24th is not okay. So Christmas Day, this just went straight down in a horrible amount of money. So up until Christmas Day of 2021, this was a wonderful little approach. After that, it wrecked the portfolio. But somebody coming in after this, they're not going to go through this. They're going to see a very good, wonderful profit. So let's do 1. So let's start the new year off right. Well, actually, that doesn't start the new year off right. Okay, so the 20th was a good recovery. So let's see if we can figure this out. 15th. You're kidding me. Okay, so the 17th, back in business. The 16th, no trades were done at all. As you can see by this chart, just straight accumulation. The 15th was just a money tank. All the way down, wiped out. So, when you look at this data, if all I had was data to the 17th of January, this is a perfect recipe, and it doesn't tell me the truth. This brings to point one of the most important things about statistics. It always tells you what you want to hear, but it will never tell you what you need to hear. Only through going through what I just did, back and forth with different numbers, are you actually going to get to what you need to hear about a given recipe. Every recipe will make money, just not all the time. You have to try hard to lose your money if you have proper risk management and money management. It's not hard to lose your money if you don't have those two things. If you do have those two things and you can weather the market, then you're not going to have any problems. Because even still, with all of this, your long-term profits are still going to be an average of 1.1%. So for $1,000, worst case scenario, 1%, $10. Best case scenario, in this case 56 trade cycles, 56% of your position size. So, in this case, $5.6 per trade cycle on average. Crude, but realistic. And yes, a month from now, this is all going to be gone, and it's all going to be milk and honey down here for somebody trading this very same recipe. In fact, they will never know this took place because they won't have access to this historic data. The fallacy of technical analysis hides the truth about just what can and does happen, and it hides it in such a way that you may never know these problems exist. Now, synchronicity does help a lot, but a lot of more complex approaches may not synchronize for a very long period of time. Don't overuse a tool. That really is the moral of this whole discussion. Every tool you have in your tool chest has a purpose, has a place, and most importantly, has a limit. Learning the best approaches can only be done through practice. Like what I did here, just playing with the numbers back and forth, watching how the chart behaved. That helps you learn the limits of the tool. From that information, you can become a better trader because you now know what the tool will and won't do. Even the simplest of recipes can be completely profitable as long as you understand how to use the tool. Understanding the limitations of technical analysis is the first step to mastering technical analysis. Like, share, ring that notification bell. Let me know what you think. How has technical analysis helped or hurt your decision-making process. Until next time.